Let's start off on the results front because Standard Chartered Bank posted slower than anticipated full-year pre-tax profit yesterday. Overall impressions of those numbers, where we saw a mere 14% increase in pre-tax profit for 2010?
I think the numbers came in much lower than what the sector has actually been doing and what local analysts actually anticipated. The profit after tax was up 13%, and this, I think, was on the back of very conservative lending environment for the bank, given that their loans and advances were actually up 6% for the year. We'll be looking to see what they do this year, generally what the benefits of the asset that they bought from Barclays Bank would be, the acquisition of the custodial business, and I think investors will be waiting to see the returns on this asset, given that money was actually deployed to this last year.
Just looking at the fundamentals of the business, of course, those operations being now, entwined into operations of Standard Chartered, that being the Barclays Bank custodial business as part of an Africa-wide deal. That's just one factor. When it comes to the pressure points, though, we had the bank warn that political uncertainty and the high oil price has posed a challenge to expansion. Let's look at how exactly it's weighing on a player like Standard Chartered, more so than some of the other players within the sector, the likes of a KCB and an equity bank as well.
I think if you look at the financials for Standard Chartered vis-a-vis the likes of KCB, Barclays and Equity Bank, they've definitely lagged behind. On an absolute basis, the bank did 5.3 billion compared to 7.3 billion for KCB, 7.1 for Equity Bank and 10.5 for Barclays Bank. If you look at it on that standalone basis, then of course it's lagging, given that it has the third largest asset base within the region. I think the financials that have been coming through from the banks for the year ended 2010 have been very strong, though 2011 may be a bit cautious as we look at the weakening of the currency, as we look at the drought situation, as we look at increased inflation levels. So the environment may not be as rosy as it was in 2010. I think most of the banks are very cautious in terms of giving outlook for 2011, but we'll wait to see how the March numbers look like, and we're very hopeful that it's going to rain, because if it rains, then it definitely offsets the dire economic environment that could actually be if it doesn't rain, if the rains don't actually come through in this year.
In the meantime, we've got Standard Chartered focusing on high-end customers by expanding its priority banking service. What have you made of that strategy?
I think it still has a strong position in its high-end banking, providing priority services to the higher end of the pyramid. It still operates in a niche environment, despite the fact that the Kenyan banking scene has become more retail-oriented, with most of the players trying to look at the retail market. Maybe the point of caution would be declining margins. In this year, there's been a push by the central bank for the banks to reduce their lending rates, and I think the beneficiaries would be those banks that actually have significant exposure in the retail market, which has had predominantly higher margins. For the banks that are actually focused on the high-end levels, on the niche markets, their margin levels could actually come slightly lower, and they may not be key beneficiaries of the retail banking spree, which is actually emerging, and also of the agency banking and mobile banking products are actually becoming quite emergent in the banking space.
Well, of course, we've had that banking sector stealing a lot of attention, but some saying that Kenyan stocks are likely to see increased trading from bargain hunters seeking undervalued stocks. And when it comes to undervalued stocks, we've got players like Safaricom and Access Kenya standing firmly in the spotlight. What's your position on Safaricom right now? It's been under extreme pressure over the recent past.
Okay, maybe before I answer your question, I'll just take a broader look at the Nairobi Stock Exchange. The market is predominantly foreign traded, and on a given day, that foreign investors would probably make up 70% compared to 30% of local investors. Over the last 2 to 3 weeks, what's been happening, there's been a flight from the Kenyan market by the foreign investors, more of a risk aversion measure, given the fact that prices of oil are actually going up, making the macro situation in Kenya much more negative than it was probably 6 months ago. And again, this is occasioned by the crisis that's going on in Libya in the northern part of Africa. Then what's happened is the foreigners have gotten out of the market, then the Kenyan investors have slowly started to get out of the market, and we've been seeing an overall decline on the stock prices across board, despite the fact that some of the financial institutions are actually reporting very strong numbers. Safaricom and Access Kenya have definitely taken a beating. Safaricom more because of a liquidity play. Most of the foreign investors actually hold Safaricom, and it's very easy to get in and get out of the name because of its liquidity. Access Kenya has taken a beating because of its profit warning. Management sometime last year passed on a profit warning, and it said that its full year numbers would be much less than they were in the year 2009. And again, there's also increased competition within its space. We have the likes of Airtel and KDN getting into the 3G network. We have the likes of Safaricom partnering with Jamii to provide broadband and internet services to over 100,000 households. If you put this into context, Access Kenya has about 6,000 connections to the household. So it becomes a very competitive environment, and it's taken a beating. But what we are seeing is at the current price level of between 9 to 9.5 on Access Kenya, the bargain hunters are actually beginning to look at the stock. Same case applies for Safaricom.
When it comes to Access Kenya, that investment merit really seems to be lacking at this stage. What are the prospects looking like for a possible takeover at Access Kenya? We know that when it was at the prime of its operations, it's resisted any calls for a possible, being positioned as a takeover target. Now, with prospects having dimmed?
I think for Access Kenya, we'd have to wait to see what management says. Management has not come out and said that it's actually looking for a takeover, despite the fact that there's been lots of market rumors in that regard. I'd not be best placed to comment on behalf of Access Kenya, but I think the best thing would be to wait to hear from management what their future plans are. And I think as they report their full year 10 numbers, then they'll give better insight into what their plans are for the year 2011.